Hi boys, welcome back to day 23. Now last time we took a deep dive into the balance sheet, how to read it, what to look for, how to compare it year over year, and all that kind of stuff. On your own time, you can do the income statement, the cash flow statement, but those are really deep dives. Once you really know a company or want to know a company, you've zoned in on that company, zoned in? You like that company and you want to know more about it, so you take a deep dive, you have to look at those financial statements, right? But what if you have a theme like, I don't know, work from home or the great reopening or whatever it is, where you have 20 companies you want to look at? Doing that kind of deep dive on each one of them, that can take a long time. There's got to be a better way. Lucky for you, there is. They're called financial metrics. Some people call them statistics, some people call them metrics. I'll call them metrics.
Dad, what are financial metrics?
I'm glad you asked. They are numbers that allow you to compare companies side by side. Usually you don't do that just for any company, but companies that are in the same industry or very similar, you can use these numbers to compare them for the particular things. Let's use a metaphor here. You go to your doctor's office for your annual checkup, right? They don't just start taking blood samples to look for Wilson's disease right away, do they? No. They check your weight, check your height. They put that thingy on your finger to measure the oxygen in your blood. They'll use their listening thing to listen to your heartbeat and to your lungs to see if there's anything funny going on there. They'll get that thing they look in your ears with and your mouth. They take your temperature. Why do they do these things rather than just testing for Wilson's disease right away? Well, if you have a fever, they know something's wrong and they can look into it further. Maybe it's the flu, maybe it's COVID, meningitis, who knows? But they know, okay, that's something they can look into further. They can start probing that. If your height to weight ratio is off and they look at your body and you're not a big muscle guy or girl and say, okay, you got some fat on you. Is it good fat, bad fat? I don't know. Maybe you need to lose some weight. They listen to your heartbeat and say, okay, maybe there's something going on there. We need to look into that more. Listen to your lungs. Ooh, if they hear something weird there, they say, okay, they need to look into something there. They push on your belly and stuff, maybe looking for a hernia, but maybe looking for other things too, if there's any lumps. Basically, it's meant to be a general check to see if there's any indications of anything they should look into further. It's not meant as a clear bill of health of you are definitely healthy. It's more, you're not showing the general signs that would indicate to us that we need to look into something further. That kind of thing. So why not test right for Wilson's disease right away? Well, because there are thousands of things they can test for. They're not going to waste your time with that. Instead, they do the big picture thing, the 50,000 foot view thing, to say, is there anything wrong there? Is there anything wrong here? Anything wrong here? Do they have a fever? Is their weight off? Their cholesterol too high? Or is their oxygen level in their blood, what, those kind of things, and go, oh, your oxygen level's low. Why is that? Then they can delve into that further. Get it? Financial metrics work the same way. They don't give you a diagnosis on exactly what's going right or wrong with the company, but they do give you a, this looks all right, or something may be off there. We've already covered one financial metric. Remember the short selling episode? Percentage of shares outstanding that are short. Well, if 5% or more shares are shorted right now, it's probably a stock you want to stay away from. Why are they shorted? You don't know. But that tells you they are shorted. There's lots of financial metrics around how big the company is, how profitable the company is, what are their earnings or lack of earnings, how fast are they growing, how much cash do they have versus debt, what's their dividend rate, are they able to pay the dividend, how much of their earnings are going to pay the dividend. Lots of things like this you compare across companies. That way you can line a bunch of companies up and say, oh, this one's more profitable, but this one pays a higher dividend, or this one does this, or this one does that. Those are what financial metrics are for. At a glance to see, oh, this is what's going on. They don't give you the full picture. Not even the balance sheet, income statement, and cash flow statement can do that. But they give you a 50,000 foot view of here's what's going on with this company at a glance, which is nice. So today I'm going to have you watch 4 videos up here, but also in the description below. These videos are on price to earnings ratio, profit margin, return on assets, and the price to sales ratio. The first 3 are great for when the company's profitable. The last one, when they're not so profitable.
4 videos? What are you doing to me, Dad?
These videos are not long and hard. They're the kind we like, short and easy. So after you watch these videos, your homework will be to simply go through the PE ratio on stocks you currently own. What do you see with those PE ratios? Which ones are high? Which ones are low? Which companies don't have PE ratios? What does that say? If you can't use the price to earnings ratio, well then, what's something you could use as a substitute? Hold on, we're not done yet. That's only 4. If you go to the Yahoo Finance statistics page, you'll see dozens and dozens of metrics. How in the world are you going to learn all those? You don't have to learn all these yet. You will over time. But if there's ever any in particular you want to learn more about, simply go to the Investopedia webpage or ask your robot dog to tell you what it is. On the Investopedia page, at least, you can read all about it, and a lot of times they even have a video explaining it as well.
The dividend payout ratio is the percentage of earnings paid to shareholders and indicates how well those earnings support the dividend payments. The dividend payout ratio can be calculated by dividing.
Now, as much as I know you want to just jump in there and start learning about all these metrics, don't. It's okay. You will learn them over time as you need to know. For instance, when you're reading a book about dividend stocks and you get to a chapter on that, you're going to learn about the payout ratio. It's important. When you want to get into profitability of a company and how efficient they are, you'll also learn about the operating margin. These are the kind of things that come with time. It's okay. You don't have to learn them all right now. As you learn more and more about business, more and more about finance, you'll pick up more and more metrics, because some of these metrics don't matter nearly as much as others. There are ones like price to earnings that really depends. It can be really high for a growth stock, it can be really low for an old stodgy stock, and it'll be non-existent if there are no earnings. There are others like book value that, as we found out in the last financial crisis, that can be completely made up. There are others like return on equity that can be a little misleading. So don't just go and learn these things and start comparing them and using them willy-nilly. You have to learn them also in context. So for now, simply watch those 4 videos and then look up the PE ratio on the stocks you already own, and let's have a discussion, okay? Time for me to get out of here. I think I'll go invisible this time. Oh, ow, oh, ow. The problem with being invisible is I can't see my own feet.